those of us familiar with the CMBS market know that the risk retention rules were published in California recently. It seems to favor the sort of non-bank lending community. How are you guys thinking about that for your business?
Well, I think, as a non-bank, we've thought long and hard that the regulatory changes, not just risk retention, Basel III, Dodd-Frank, would continue to have an impact. And I think, as a borrower for many of the folks on this panel, we see that there will be a continual shift towards maybe financing people who finance borrowers, and that may be a longer-term shift than maybe even we thought about. As it relates to the risk retention rules, I think one question I have is the 5% rules that will apply in 2016 to standalone securitizations. How will that change that market? It seems like it'll price those deals wider, which means many of those loans may get put back into conduit deals. So could be we're back to where we started from, which is many of the standalone deals will go back into conduit securitizations.
Or one of the Robert.
Yes, I was going to say that. That may help us get back into the larger single transaction type deals.
Mark, are you guys positioning for this as well?
I think it's tough because we still look at the BPs absorbing the allowing them to actually the banks to get their positions off the book. So I think we would actually applaud having to have retention, but I still wonder how I think that the banks will find a way to allow the BPs to actually clear that. So though I would root for it, I'm not sure that it's going to work out the way I want.
And what about you, David, as a bank in the space? How do you think about positioning your conduit business for the future?
Listen, I think 2015 through 17 are certainly going to be significant years in terms of the velocity and the number of loans that need to be refinanced in addition to the other activity. So we expect a very busy 3-year period coming up. As it relates to risk retention, especially to Anthony's point on the single asset deals, I do think that's going to be an opportunity. And it could be a bit of both for insurance companies as well as new investors in the market that want to try to satisfy that risk retention rule on these lower risk, lower reward trophy asset transactions, taking the bottom 5%, which has typically been a much lower yield than where B pieces are trading in the mid-teens on a nominal basis. The only other point I'd add is in Europe, risk retention rules are actually already in play. We've done several CMBS transactions where we have risk retained, and other dealers as well are doing that. So I think you could see a willingness from the banking community to retain risk. I think certain transactions, even with Basel III, do look very attractive to CMBS lenders.
I guess picking up on that question, you Mike, because you face the LP investing community. David's hypothesis that investors such as yourself might be the home for the risk retention on a large loan deal. That's going to be a pretty low cost of capital. Is that something that you're seeing demand for from global investors?
We haven't asked, so we haven't had reverse inquiry from these sort of investors as to how low a yield they accept through us. That model doesn't work as well for what we do. We try to get paid a little bit more for complexity and for higher returns. I think generally it could create some opportunities for a franchise like us because we know that asset base as well as anyone will probably want more prolific issuers in that space. So it's easy for us to buy in people similar type deals. But something on the drawing board. I don't know if we're the right home for that long term, but it's possible.
Jeff, you originate a lot of different types of real estate debt for your platform. Where do you see the best value right now? What type of deal? What part of the capital structure? What suits you the most?
I don't know that we see value anywhere right now. Perfectly honest with you. We've been really just trying to move around the market to stay away from where kind of the flood of capital has arrived, and it seems to be everywhere. When I think about our book specifically, I think one of the panelists mentioned that they've been fairly active in the floating rate business, and we have as well. That's for a fund that's trying to build a book. It's actually very difficult to do so when you have short-term floaters that are paying off quite frequently. So even though it may not look like it, I think for us, when we think about what our book's going to start to